Fine. So let us learn about stock valuation. This will be our agenda, where we are going to work on the different closing stock valuation methods, different valuation methods, and product walkthrough, of course. Fine. So what do you mean by closing stock? Closing stock are the unsold products as on date. In a sense, like whatever stock you are having in your business, which you have kept with the purpose of selling, is your stock. Fine. But while closing the books, whatever stock you are having left out in your business will be called as closing stock. Fine. So for example, here in India, we follow the financial year from April to March. That is from 1st April to 31st March of the next financial, to the next year. Similarly, I think internationally we follow January to December, right? So on 31st December, let's say whatever closing stock is there, that will be the opening stock on 1st Jan. So this closing stock is actually the unsold products as on date. So why inventory valuation is important? First, for financial reporting and to comply with accounting standards. So of course, we are going to value those inventory valuation once it's done. The closing stock or the closing value of the inventory will be reflected in our P&L statements, which will be further carried to in the valuation of our balance sheet as well, right? And to comply with accounting standards also it's necessary. Next, it comes to tax implications. What are the tax payments we are going to do from our business? So of course, even the inventory valuation adds a role there. Next, decision making like pricing, purchasing, and production, as it enables you to identify the worth of your inventory. So we are actually going to decide the worth of our inventory we are having in our business. Based on that, we can take pricing decisions. Okay, if I'm having a worth inventory of 1 lakh, then based on that, how much sales if we make, every companies will be having their sales targets, right? So what is the actual sales they are supposed to make? All those decision making, like inventory valuation, the total closing stock in of your business is going to help you with valuing the inventory. What are the different methods of closing stock valuation? Let us have a look at it. FIFO, first in, first out. LIFO, last in, first out. Average cost and standard costing. This weighted or moving average cost is actually at present banned in India. So I'll tell you about it in a short brief as well. Fine, so let us see. First in, first out, I think you all might surely be aware about the basic part in this. So what you're purchasing first will be sold first. Okay. Whatever you're purchasing first will be sold first. Suppose if I have bought a product for 10,000, okay. Let's say I bought 100 units for 100 rupees each on first day, and then I have bought again 100 more units for 200 each. So first, if you're making and clearing out the sales of 100 rupees unit, then that is first in, first out. It means that what you have purchased first, you will be selling first, and what you have purchased later, you're going to have it in your business, right, for further sales. So once this 100 rupees stock is cleared only, you are going to sell the second lot of it, that is 200 rupees stock. Whereas it's vice versa in case of LIFO, where if you are bought 100 rupees stock and 200 rupees stock, first you're going to clear out the 200 rupees stock and then you're going to move to the 100 rupees stock. Okay, so that's just vice versa to FIFO, it's LIFO. Average cost, whatever products you are selling, the total, as it is treated as a single product, like the total average value or the average rate is always considered here. Okay, and next we are having standard costing, where we are going to set the standard price for a product. Based on that, the valuation will be happening. Weighted or moving average cost is similar to average cost, but in average cost we consider it total from in the entire financial year together. The valuation is considered, whereas in case of weighted or moving average cost, we consider it on monthly basis. Okay, so LIFO at present is banned in India because of the misuse of the information. Fine. I mean, if you're making a type of purchase, then the book's value was like the values of the stock in the books were misplaced. or they used to devalue it wantedly and then show the stock. In order to avoid these malpractices, LIFO has been banned in India, and weighted and moving average also, like this is not supported in Tally at present. Okay. So now let us move further with FIFO. First item that you purchase or produce is the first one to be sold off, as mentioned earlier. So this comes under FIFO, first in, first out. Next, second point, remaining stock items after the sales are from the most recent purchase or production. It means that whatever latest you have purchased, that is still going to be there in your stock, okay? And the one which you have purchased earlier will be sold first. So this point means actually that. Next, if the cost of the item is increasing, the value of the closing stock inflates or will be higher. So of course, you might have bought the later products you might have bought at higher rate. Okay. So this is basically mostly used, not basically, but mostly used in those type of businesses where the stock item, where the value of stock items is increasing day by day. Fine. So the old stock, which is of less value, they'll be having it in their business, and they're going to clear that first, right? And the latest stock item, they are going to have it in their business. Now let us see the consumption cost. Consumption cost is equal to quantity sold into respective purchase cost, and closing value is respective purchase cost. Closing quantity into respective purchase cost. Fine. So this is with respect to FIFO. I'll be showing it in the product. So let us have this illustration or example. You can take a screenshot of it, and we are going to record transactions based on this in our Tally application. Okay. Fine. So in this PPT, we are having some values, and here I have created a company as Stock Valuation. It's a new company. We have to create. Let me just create some of the ledgers. Let's say the first stock item is FIFO. Okay, but then here we'll have to go to F12 configuration of the stock item screen, and then enable the option to use costing and market valuation methods for stock items, yes, and accept. So once you accept here, the market valuation method of the item can be seen. So here we'll have to select FIFO. So now, the first illustration says here, if you are making purchase of 100 units inwards at 100 rupees each, okay. ₹100 inwards for 100 rupees each. And then the second illustration says, again we are making a purchase of 100 more units at 120 each. Fine. So now when we go and see the stock summary value for FIFO, we are getting 22,000 as a stock valuation. The same closing balance we are getting here as well. Okay. Now how are we getting this value? The calculation part is something to be observed here. Okay, so on an average basis, you can consider like 10,000 plus 12,000 is 22,000, and 100 plus 100 is 200. Okay. So we are getting this 110 on average basis. 22,000 divided by 200 is 110. Okay. So if you are doing this value divided by quantity, it will be called as average valuation. But the way how the calculation is happening here in essence, it's considering 100 into 100 is 10,000 plus 100 into 120 is 12,000. So 10,000 plus 12,000 is 22,000. 100 plus 100 is 200 stock. So here rate, whenever you are getting the closing rate, it will be the average rate of these items itself, the closing rate, okay? But when it comes to FIFO, in the FIFO valuation method, we are actually supposed to consider the closing value. Fine. How are we getting the closing value? So now, as per illustration, let us go on the sales transaction. On 3rd April, we are passing a sales entry of 60 units at 150 each. Say we are making sales of 60 units at 150 each and accepted. So after accepting, we are getting this closing stock of 16,000. Now, how are we getting the 16,000? If we minus 9,000 from 22,000, will we get the closing stock here? No. Fine. So let me show you the calculation part, how this works. Okay. So here, because we have made sales from FIFO valuation method, first in, first out, from 100 rupees stock, we have got like 60 pieces is out, 60 units is out. So remaining 40 units. 40 multiplied by 100 plus 100 into 120. So 40 into 100 is 4,000 plus 12,000. So 12,000 plus 4,000 is 16,000. This is how we have got the closing stock under FIFO valuation method. Okay. First in, first out. The first what we had made purchase, we are making, whenever we are making sales, we will first clear that stock and then only we are going to consider the next part. Okay, so after this it says that we are passing a delivery note. We are passing a delivery note with 50 pieces for 150 each. Tracking number I'll keep not applicable. 50 for 150 each, 7,500 on 4th April. Accept. Now that we have made sales at for 7,500, now if you have a look, the value what we are having is 10,800. Now how did we get this value? We had 40 pieces remaining. So this 40 pieces is cleared completely. Okay. And from this 100 pieces, 10 pieces is gone in that, contributing in that total 50 pieces. Remaining 90 pieces multiplied by 120 value, we are getting 10,800. Okay. Where in delivery note you have sent the stock. Okay, and next. Moving to the next illustration, that is of receipt note, 50 into 150 each for 7,500. So we are passing a receipt note. Where input is 50 into 150 each. 50 for 150 each. So now a new valuation has been added, 90 into 120 plus 50 into 150. So 10,800 plus 7,500 is 18,300. So when you are receiving the goods, again there is an inward happening in your business. So that value will it's going to get added on its original cost of purchase. Okay, at the original cost of purchase, we are going to get the valuation. Here, whatever closing rate we are going to get, we are getting it on average valuation method basis, because here we have considered for market valuation price, we have considered average price. Here there is no option of FIFO. So we'll take average price here, but here in costing method, we are taking FIFO valuation method for the closing balance. Okay, the pricing is something that's coming on average price basis, and the valuation what we are doing, it's on FIFO basis. And next, if we do inter-godown transfer, there is no changes going to happen because both the stock are going to remain in our business. There is no effect. Okay, so let us first create a godown. That might be location there. Let's use this for inter-godown transfer, where we are going to take FIFO from main location, 10 pieces, 120 each. But then this is not going to change any type of changes here because the stock remains in our business, so there is no changes. Okay. So I hope that the FIFO valuation method is clear to all of you. Any doubts still here?
Ma'am, can you make a credit note?
Sorry? You want me to raise a debit note? Credit note.
Yes, ma'am. Against the first bit.
Against the first bill you want me to take it. Okay, 1 minute. In pieces for 150 each on 3rd April. If you are getting purchase returns, here we'll get the value in negative. Okay, under sales it is getting minus. So basically it is going to consider inward. But then because we have to minus it from our sales value, it will be showing under outwards itself, but the value will be negative. Similarly, if we raise a debit note, it is going to come under inward but a negative value. Okay. Next, let us go
Can
to
you
the
explain the value?
Yes.
Can you explain the value?
Value, how we are
I'm
getting here
taking
19,500.
How we get 130?
Quantity, see here, the closing balance is 140. Okay. Just a minute, I'll change the date for this. So here we are having 140 units at 137, like for 18,300 rupees stock each. So once we have made a return of 10 units for 150 each, here the valuation changes. So 140 stock, like it's going to remain here. From 100 each, we are going to, like this sale was made from 100 rupees stock. So 10 into 100. Let's take 10 into 100 plus the closing stock, whatever we are having is common rest, 90 into 120. . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . And then remaining, we have made sales from here. 60 units from here we have made, and 50 units delivery note from 120 each, like from 120 10. Oh, just a minute. And 50 receipt note again we have passed, so 50 into 150 each. So 10 into 100 is 1000. 90 into 120 is 10,800. And 50 into 150 is 7,500. Yes, it's okay. We are getting here 19,300. It is including the stock valuation, I guess. 200 rupees we are getting extra here. Okay, here it is taking from 1,200 from 120 consumption basis. Even if you have taken it on 100 each, but still the consumption it is calculating on the second purchase of this unit from delivery note. Okay, I'll just check on this and I'll get back to you sure on this. Okay.
Okay.
Next, let us move to the next valuation. Okay, in LIFO, the last stock items that were purchased or that were purchased or produced are sold off first. So of course, like the FIFO, just opposite to that LIFO. This indicates that the stock item, that the stock in hand may be from any older batches. If the cost of the item is increasing, the value of closing stock deflates or will be lesser. Fine. If the value of the stock is increasing, then the value goes down actually. Fine. Next, coming to the LIFO, consumption cost is equals to quantity sold into respective purchase cost. So this is same. Closing value is respective purchase cost. So this is actually same when it comes to FIFO or LIFO or any like an average cost as well. So I'll just show it here. In F12 configurations, there is an option to show consumption and gross profits as yes, we'll consider. Now, how are we getting this consumption of 6,000 in a sense? 60 units we have sold. So 60 into this is being sold from this stock. So 60 into 100 is 6,000. Okay. So this is how we are calculating the consumption. If 50 units is being sold, so out of this 40 units is from 100. So 40 into 100 plus 10 into 120, 5,200. Based on that, we are getting this calculation. So this is how the consumption is calculated. Based on the consumption and the difference value of the purchase and selling rate, we'll get gross profit, and then the same value will be showing us in percentage. So what is the percentage of profit we have made? So LIFO is banned in India under the Indian Accounting Standards IAS and AS issued by ICAI. LIFO is banned even by IFRS, that is International Financial Reporting System, due to its potential to mislead inventory valuation and financial reporting. So I feel it's not required, so I'm not going to show this part in the product. LIFO will not be doing. Let us move further with the average cost. But then I hope that the normal understanding is clear on this, that it's just vice versa to FIFO method. Next, moving to the average cost. This is the formula which is being given. So average cost per unit is equals to total value or total inward value divided by total inward quantity, and consumption cost is quantity sold multiplied by average cost per unit. So here considers average cost of the inventory available for sale, does not consider the actual cost incurred, hence simple, and applied by the businesses with homogeneous goods and non-perishable goods. So in most of the companies or like in most of the industries, inventory industry if we see, if the products are similar, they are going to use this average valuation method there for calculation, okay, based on the similar products. So now let us create the next stock item as average. Also in Tally application, average cost and average price are the default valuation methods which it is going to pick here. I'm going to accept this and move to the illustration part. So first purchase we are making for 100 units on 100 each. So similar actually. So first let me record all these transactions. Based on that we'll show you the valuation. Next I'm taking the next purchase for 100 at 120 each. Each. Yes. So let us use this option. Yeah. So if you take we have passed two purchase transactions first, 100 into 100 each, that is 10,000, 22,000. So here value we are getting same, closing stock. So, but then for FIFO valuation method, what we used to do is, we used to consider the entire total, I mean like item wise. So on the rate basis, we had categorized the item value and then we were adding that. But in case of average, it takes total, it considers the complete total. So 30,700, 10,000 plus 12,000, 22,000 actually. So this is going to consider this total value here. Okay. Okay. It's because we have passed the other transactions also, it is coming here like this. So here if we see 22,000 divided by 200, we'll get this average rate. So total value divided by total quantity, we'll get the rate. So this rate we have to multiply by the closing quantity and get the average rate. Here sales we have made of 60 into 150 each. So 60 units is gone. This 140 units we are having balance and then 15,400 value stock. So how are we getting this 15,400 in a sense? This 110 closing value is 110 multiplied by 140. We'll be getting 15,400. Okay. Again, we have made an outward. We are having 90 pieces. Same closing value is maintained till here. In receipt note, just a minute. Yeah. So even here also, after this invert, whenever like the average rate will get affected only after an invert is happening in business. Fine. So here if you observe, after the first invert the value was 100. After the second invert it is 110. The value was constant here, but after the receipt note again it is 118. And at present the value what we are having is 1000. Yeah, the closing stock 118.08 has been multiplied here to 118.14. So now when we see this consumption value will also going to pick on average basis. So 60 into 110 is 6,600. Okay. So this is how the calculation is going to happen of closing stock. A minute. So after this Godown entry, we are having some changes. Because I have changed the rate here, 1 minute. And here the rate which they have given is also wrong. Fine. So this closing stock entry, we are getting difference. Because I have changed the rate in the stock journal, that's the reason we are getting a different rate here. On the average basis, it was picking the last closing rate, but because we have made the changes in the rate, here the rate is different for the closing stock and the total inward. Okay. Yeah. So now it remains constant, 118. Fine. So total inward value divided by total closing quantity, total inward quantity, will get an average rate. This average rate will be multiplied by total closing quantity whichever is remaining, and we'll get the closing stock value in the average method basis. Fine. It is not going to consider on FIFO or LIFO basis, okay, that we have bought the product at this value. We are supposed to make purchase consideration or sale consideration this price itself. It is not bound to such limits, and you can take on an average basis. I hope this is clear. In the average cost valuation method. Next, standard cost assigns a fixed or predetermined cost per unit of inventory based on predetermined standards for materials, labor, and overhead. So whatever cost you are assigning, you're going to set a fixed cost for a particular item. Based on that itself, the calculation is going to happen here. Next, applied by businesses trading or manufacturing standardized products wherein cost can be estimated based on the historical data, example construction product and with service. So based on the historical data, you can actually set the product or the pricing. I mean, we can set multiple applicable dates there. Business compare the actual cost with the standard cost to reduce expenses and improve efficiency and profitability. So it also helps in decision making there. So where can we reduce the cost? How is it possible? It helps in such decision making as well. And standard value is assigned after raw material standard value over its standard value. So inventory value is equals to quantity on hand into standard price. So standard price is the one which we are going to consider here. So now let us create a new stock item again. But then here we are going to select the method is standard cost, and here we'll select standard price. But then where can we set the standard cost or standard price? We have to enable the F12 configurations here. And then enable the option to provide standard and buying and selling date, yes. Control A, accept. And now if you enable the option to set standard rates, yes, from 1st April. Let's say if I want to make a purchase, the cost will be 500. And if I want to make sales, let the cost be 1000. We'll accept it. Let me just record a purchase transaction. So for this, we don't have any illustration there. I'll consider it from 15th May. The moment I select quantity, rate is coming automatically. Whereas this was not happening in the previous transactions. The moment in the previous transaction, if the moment we used to take the quantity, rate would not pick automatically. Because the first time rate we have to enter it manually. Based on the history, next time it is going to pick. But in case of standard cost, once you mention the applicable date and you mention the rate, you can surely pass the transaction. It's not that you cannot make the changes, we can make the changes and record the transaction. Now suppose I have bought 10 pieces and like I'm purchasing it in Word and more pieces again I'm purchasing on 16th May as well. Let's say from 17th May the price have got changed. On 17th May the price was revised where the rate was changed to 550 cost price. Sale price remains 1000 and we'll accept it. So the moment I select now quantity, the price will get changed. It is automatically picking 550 based on the historical. So if you remember the point from the PPT, the previous rates are also stored in the business. It is also going to store that data based on the different multiple applicable dates for the standard cost. We are going to record this transaction, and now if I see the stock summary, standard item. Whatever my standard price is there at the end, I'm going to get the valuation based on that. Okay, the latest rate. Let me pass a sales transaction. Uh, for 1000 each on 17th May. But still, whatever the valuation stock we are having, it is going to store it at the latest purchase price what we had, the standard price. Okay, so the standard price was 550. Based on that itself, the closing stock valuation will be done. quantity in hand into standard price. So whatever the latest standard price we are having in our books will be considered. So this, we are having this moving or weighted average, but then we are not going to record this in tally. Okay, let us just have a conceptual look. So the average cost of each inventory item is stock is recalculated after every inventory purchase. Thus, moving average changes after every purchase or inward. The method is applied in case of perpetual inventory system only with software.
Manisha,
Applied by cases with time.
sorry to interrupt.
Yes, sir.
I think in the chat, Nadia said, can you go a bit slow? Don't know whether this is considered.
Oh, sorry, sir.
Yeah. Yeah.
Okay.
Noted, guys. Whatever we have entered in the chat, it is noted. She will take care.
Yes. Okay, thank you guys. Fine. Here the costing method, this weighted or average moving cost is at present, we are not following this. It's not been there in the product. If you see the behavior, it behaves same as per the average valuation method itself. Okay. So we'll not move into this. Let us have a impact, like look on the impact of how it was impacting in case of FIFO, voucher impact matrix. When it comes to transaction type, purchases, if you are making any type of purchases, then quantity is going to increase, closing stock value will increase. So adds the new purchase value to the closing stock value. Okay. Next, if you make sales, then of course it is going to decrease, which is going to reduce the value of your closing stock. When it comes to receipt note, we are having the value of both the stocks, like the value of stock is going to increase here, where it is calculated on the based on the average rate. Fine. So I have a question here. What is the difference between FIFO and FIFO perpetual? Like we are having an option of FIFO perpetual here. How are these two different? And what could be the effect in the books? I would want the session to be little interactive, so you can actually unmute and speak. When it comes to FIFO valuation method, the price or the rate what we are having here will get the average rate. Okay, so 19,500 divided by 150, we are getting the average rate, which we are considering it as a closing stock value here. Fine. But then this average rate is going to come forward in the next financial year. When we are going to start the new financial year, the same average rate will get continued, where the average method itself will get continued there. Okay. So in order to like if you want to maintain the FIFO method itself continuously in the next financial year also, we have to maintain FIFO perpetual. Perpetual in essence continuous. So if you want to maintain it continuously in the next financial year also, financial like FIFO method itself, then we have to select FIFO perpetual. Or else on the rate basis, when we see in this financial year, you might have made it FIFO for this for a particular stock item. If you have kept it as FIFO, in the next financial year, when you are moving, it is going to take the average method in the beginning. In the initial, it is going to take the average price and not the FIFO price, even if the data is being continued in the same company. Okay, so that's the reason we maintain FIFO perpetual. The same thing the same thing applies for LIFO perpetual as well. Okay. Receipt note, the value increases, the closing stock quantity increases as well as the value increases. And in case of delivery note, the value is decreasing as well as the quantity is decreasing. When we do any type of rejection out, the quantity decreases and even the value also decreases. Okay, because we are rejecting it. So it is going to take the average rate, whatever we are having the latest rate in the stock item, it is going to pick based on that. In case of FIFO, how it works? I mean here in rejection in, the value is increasing along with the quantity. In debit note, it decreases. Again, purchase returns, we are returning goods is going out of the business, it is going to decrease the value as well as stock. Credit note, again it is going to increase, even if we are getting the value here in negative in the stock summary, but still the quantity is being added. Quantity is still being added even if we are getting the negative under outwards. Quantity is added here, so based on that we are getting where the value is increasing. Physical stock increase or decrease, it depends on the type of transaction we are passing. Okay. So the closing quantity as well as the value will have an impact based on what we are entering as the closing quantity there. For Godown transfer, there is no impact. We had recorded this transaction and you all had seen where there was no changes happening in the books. And next, if you record JV or payment, closing stock quantity will not have any type of impact, but then the valuation will. Okay. So expense value is added to the closing value considered in cost of goods sold if entry exists before outwards. So if you are recording any type of JV or payment entry where you are selecting the stock items in valuation, then of course then the quantity will be added there. Okay, we are having some 2 to 3 questions. Okay, based on the scenarios. So let us be a bit interactive and you can answer these actually. So Roshan traders have completed books finalization as on 31st March 2024. Auditor has recorded the closing stock value and shared the details. Now Roshan trader wants to now enter the opening stock details manually as on 1st April 24. How is it possible to enter opening stock manually? Can we enter opening stock manually? Here the steps are given to use the stock in hand ledger. Suppose for example, we are going to profit and loss statement. I'm having opening stock 0, but then closing stock I'm having 41,520. I will say that no, my closing stock is 50,000 and I'm having an opening stock also of 10,000 in this particular financial year. I want to show that values only in my reporting part. I'll have to create a ledger as stock in hand. Under stock in hand. Next we have to go to the alter ledger stock in hand. So as on 1st April, I'm having opening value of 10,000 in debit, and closing we can decide the date actually. So let's say on 31st May, I'm having a closing value of 50,000. Now when I go and see my P&L statement, still the value is not reflecting because in F11 company features, there is an option of integrating accounts with inventory. This is yes. If you make this no and then accept, then the value what you have given will be showing. Here we are having 10,000 because in May month we have given till 31st. So reporting till date supposed to be 31st May. Okay. So the date whatever you have entered, if you enter that date, then the closing stock value is going to pick. Next. Divan Plastic Products Limited has completed the physical stock verification and identified the shortfall in closing quantity and value. How to adjust the stock and stock value? And here Divan company is following the FIFO valuation method. So what could be the solution here? Physical stock verification, in a sense, they are doing physical stock, like they are doing the physical counting of the books, right? I mean the items in the business. So I have to record a physical stock voucher to reduce the quantity. Select the Godown and batch in which the quantity is to be reduced. Record rejection out to reduce the value. So formula to consider for rejection out is given here. Okay. Let me enable this option. integrate accounts with inventory as yes and accept. Now suppose I'll go to stock summary under FIFO valuation method. Let's say I have done the physical counting of vouchers, and according to that I'm not having 150 pieces, I'm having 145 pieces in my business. Okay, so this is showing 150 pieces, right? But I want to show 145 pieces in my business. So till 7th April, 8th April, let me record a transaction. I have to record physical stock. And on 8th April, we'll record this entry. Where I'll take the item. Here in Godown, we have to select, okay, in which Godown we want to make these changes, fine. So when we have done inter-Godown transfer in location A and location B. Now suppose if I want to change it in main location, we are having 140. In location B, we are having 10 pieces. Okay, from which location we want to reduce? You have to mention that thing here. Suppose I want to mention it, I want to reduce it from location B. 5. One minute. Let's go to the stock summary, FIFO valuation methods. We are having 145. Fine. Physical stock, it is showing quantity of 5 pieces is being reduced and 145. When you see outside, if we see the detailed information for this, then we are having location B 5 pieces and main location 140 pieces. So this is happening because of the physical stock voucher. Okay. So because of the physical stock voucher, the value is like the value from the location we have got reduced for the item. I hope this is clear. Now it says to, if you want to reduce the value, you have to record rejection out. Suppose I'm getting the value of goods as 18,900, but actually whenever we are doing such type of transactions, you have to make sure if the customer is having multiple godowns, and if they're maintaining batches. Okay, if they're having multiple godowns, you're supposed to reduce the value godown wise. In a sense, you have to go to display, inventory books, godowns. In this godown, if you see the detailed information, for FIFO valuation method, we are having 600 value stock, whereas in main location, we are having the value of stock is 18,300. You have to decide from where you want to reduce. In total, if you reduce, it won't work out. So you have to do it at godown wise separately. It might be an average valuation method, or it might be in FIFO valuation method. Okay. So whenever you are reducing the value of stock in the business, you're supposed to consider this. So now suppose I want to reduce from here, I need to reduce the value of let's say 3,300. Okay, and I want to bring this value to 15,000 only at the main location for FIFO stock. Record a rejection out. You have to select the name of the stock item. Location, we have to mention it carefully, and directly value. We are not supposed to mention the quantity here if you don't want to reduce the quantity. 3,300. Accepting the transaction, we'll get this error as no entries in voucher because we have not mentioned the quantity. So in such type of scenarios, you're supposed to go to the alteration screen of rejection out and enable the option of zero value transactions as yes and accept. Now whatever difference value you want to reduce, you'll have to enter it and then press Ctrl A, accept it. Now if I go to stock, I'll go to display inventory books, godowns. So now if I see the valuation, I have changed it. From 18,000, if you reduce 3,300, we'll get the value of stock 15,000, right? So if you see this value, it might happen that customers are saying that no, this is not working out. It's not calculating properly. The value is not being reduced. If such customers are saying such things, you are supposed to check it Godown wise, or in case of batches, if they are maintaining, you are supposed to cross check with batches as well, because here total average stock will be getting value. But how that calculation is happening, it's happening Godown wise. So I hope that this is also clear to all of you. Next. National Traders books as on 30th April 2024 is showing closing stock value for few items. They have cleared all the stock and there is no stock available. For few items, the negative stock value is displayed. Why? Okay, so let's say National Traders is having books, they are maintaining their books till 30th April 24, and they say that they have closed all this closing stock. It's cleared, but still they are getting negative stock in their books. So there could be reasons in mismatch in Godown or batch allocation due to improper record of invoice. So solution is we have to we have to make the corrections in the batches or Godown allocation. Suppose, for example, let me show you here. Let us take average item for this. I'm having 100 stock in main location itself. But then here, while making sales, okay, I'm having stock in location B. But if I take main location and make sales, here the value will be total. First, the closing value is the closing rate is going to get affected. First thing. Second, value will be showing, but the same information from outside, if you see in detail, in location B we are having stock, but location A, in main location, it is showing the value in negative. So this is the scenario what they have asked for, okay, where we have given the value, but then it is still showing in negative. So what could be the solution for this? So we have to go and make proper. You have to identify that from where the valuation is getting changed, the total valuation, and you have to go and make the respective corrections from there. Once these corrections are made, it will be proper. We'll get the value in positive. So such type of corrections is required, or if you're passing a physical stock voucher or a stock journal entry, in that cases also we'll get this